Right. So what I'm going to do right now is an exercise I do at the beginning of every year called the worst to the first. And this year we have, what I did was I included in my last week's notes the S&P 500 best performers, which is this Excel spreadsheet, and worst performers. And a lot of times at the beginning of the year, you have a switch. The best becomes the first, and the first becomes the worst. And so what we see in today's session is we see a lot of the ones that did the best in last year's performance, like Riot Platforms. That ends up being one of the worst performers today. For instance, the Marathon Holdings, Riot, it's down 7% today. So you see a lot of repositioning at the beginning of the year. If you're a beginner investor, your natural tendency is if things are going good, pile into it so that it'll be good again this year. But in reality, there's always a reversion to a norm, and you have to make sure that you don't get overextended in what you're doing and assume things that have done good in the past will do good again this year. So let's look at hold on. Okay, this is a good time to look at the annual sector performance. Okay, so last year we had not telecom, but communication services, tech, all doing really good. Yeah, like up 40%. And you had the financials, the health, consolidated real estate, utilities, all down negative. Now what's happening is, so far this year, we're having like a little switch where it's the ones that are utilities, real estate, health, financials are outperforming, and the ones underperforming are the ones that did good last year. So let's look at some real numbers here because I did that exercise here. This is our list of good and bad sectors for last year, and I just updated them as of today. You can see utilities are the best performing sector so far this year. They were the worst last year. So what we have right now is we have interest rates going down. That's going to make it very hard for people to get a yield on their investments. So they're going to be gravitating towards these safe investments such as energy, consumer staples, healthcare that pay a dividend. And the high dividend stocks are going to, like a telecom and utilities are going to be in demand. Anyway, I just noticed that that's the first week of the year. This is what's actually happening. We're having this kind of repositioning. And a lot of this has to do with new money coming into the market, with the retirement accounts, and a lot of reshuffling going on in January. And there are people that want to take profits. They didn't want to take profits at the end of last year, and they want to take profits this year on the ones that did good. So there's a little bit of a rotation going on. You can see that in the top performing stocks and the worst performing stocks this year. So let's look at some of the things that are going up and down in the stock market right now. We see a lot of semiconductors in the top 10. We have Marvell, you have AMD, NVIDIA. These are all AI chips related companies. Okay. And Meta. All right. So we have the ones doing the worst today happen to be packaged good companies, Pepsi, Dr. Pepper, Coca-Cola. Wow, those are all drink companies. Wonder why they're all down. Okay, so these are more conservative companies. I'm not sure why this whole sector is down, the soft drink companies. Let's look at the S&P. A lot of travel and leisure companies are doing good today. Those are the ones that did the best last year. Let's look at some of the best performing ones last year. You have Royal Caribbean up 150%. You had Carnival up 130%. So, and then those are still doing good this year. So that's interesting. American Airlines, a lot of travel companies going up today. The ones doing the worst, I mean, these are very conservative companies. I'm surprised they'd be going down. Okay, that was a good exercise. Let's look at some of the ETFs that are doing good and bad today. Oil is doing bad. We have biotech, real estate. Okay, these are all sectors that do bad when interest rates go up. So what we have today is interest rates. On the front page of Yahoo Finance, you'll see, here it is. The interest rates have gone up for the 2-year Treasury and the 10-year Treasury have gone up a lot. This is like, it doesn't seem like a lot, 5 cents, but it's a lot percentage-wise. And that's because we had a good labor report. Let's look at that report. Okay, so if the economy is doing good, the labor report just had a really good report. That means that the economy is doing very good. And if the economy is doing very good, the Fed will have to raise interest rates or keep them higher for longer, and that's bad for stocks. So I'm surprised the stock market's up today because that's bad news for the stock market. That means interest rates are going up and stocks are probably going to go down. So we can see the correlation between interest rates. It continues. Interest rates are going up this week, and as interest rates go up, you can see the S&P goes down. So we're basically at the mercy of the Treasury market and the stock market. It follows an inverse correlation right now. So that's the bad news. It looks like we're gonna be going down today. This is the S&P right now. You can see we're almost to the point where we're oversold, and that's almost. So we have another 10 or 20% to go in our stochastics before we bottomed out. So probably in a week or two, we'll be back at a point where we can buy again. And so I'm expecting, we have a couple things, if we look at our calendar, there's a couple things to look forward to in January. We have earnings reports starting next week. That's the big banks start their earnings reports on the 12th. And then towards the end of the month, we have big tech earnings like Apple, Google, Amazon. So all those big tech stocks are reporting here. So that's a good kick in the pants for the market. So in the meantime, we could be going down, but we still have, if we look at our S&P, we still have an uptrend. And maybe by the time tech earnings happen, we'll be going down and the stochastics will be bottomed out. But a lot of times you have to look for a catalyst of what will get us from an oversold position to an overbought position. So a lot of times earnings helps there. So that's kind of what's going on. Right now what's happening in the stock market is we're going down this week, and you can see we're almost at an oversold spot on a lot of these indices, like the QQQs. This is the big tech stocks index. They're almost at a point where they're oversold. But they're still within this trading range that we've been following. So that's good. But if it breaks, we're going to look right here. If it breaks that level, then it'll probably go down lower than that. Let's hope it doesn't, because that's been good for a whole year now. There are some sectors that are breaking out, and like the healthcare, let's look at the healthcare. So a lot of the ones that did bad last year, the XLC is still doing good from last year. These are the Facebook, Google, etc. Let's look at the XLV. This is a healthcare ETF. You can see it's starting to break out of this sideways channel, and we go with our worst to first theme for this year. So healthcare utilities is going to start breaking out too. XLI, you can see that industrials. This is an example of a consumer staple. These stocks pay dividend, like Procter and Gamble, like Tide, those kind of stocks. that could be what's in favor this year. And if it starts breaking out of this downtrend, that could be the new leader. And financial sector is in the same position. It's in the possibility of breaking out into newer highs. Because as interest rates go down, that's good for the banks in their net interest margin. So let's look at utilities. You can see that they're in the process of breaking out of this and becoming a new leader. What we're going to do is we're going to look at some of the sectors that are going to become the new leaders, maybe, of this market. I already told you about this 10-year Treasury. So right now, it is going up. And as this goes up, looks like the S&P is going to go down. But we'll see what happens there. Right now, the price of oil is 72. And it's around 72. That's an indication that there's a possible recession coming. And stocks that do good around the recessions, we have to keep track of that. Amazon is a good company that would take market share in a recession. There's a couple other ones we'll mention later. Inflation is going down. It was 3.14, now it's 3.1. So that's good for the stock market. The US dollar is going up a bit. So it's stopping going down just for a week. Fear and greed. We were extreme greed last week. Now we're getting to greed. If we get more selling like this week, we'll go down to fear. And that's the time to start looking to buy. Okay, so now let's look at investor sentiment. It's still bullish. So this is contrary indicator. It's still not a good time to buy. Oh, crap. I need to put my cable on. Hold on. Now we got that. Yeah. Okay, so let's look at the dollar index. It continues to go down. You can see we're in a downward trend. That's good for the stock market. If it breaks out of this trend and then starts going up again, there's a lot of big companies like Google, Microsoft, Apple, Facebook that are going to be doing bad because the dollar is going to be working against them. And they'll earn like 10% less if the dollar appreciates in value. So let's hope it keeps going down like that. The VIX is staying right around 12 to 14. Right now it's 14. That means people still aren't afraid yet. There's no fear in the market, and that's really good for stocks. So we're currently still in an uptrend in the stock market, and things are going good. But this week we're getting a little bit of fear in the market. So people are starting to get into this denial stage, and they're holding this investment sentiment surveys. Means they're still bullish, but as soon as there's a lot of selling, they're going to switch to like mostly bearish. So right now we don't have fear yet, and we're like in a denial stage. And let me see the things that we have to worry about. Interest rates coming down helps a lot of these issues that we were worried about. High gas prices, they're going down. And then the one thing we still have to worry about is tech stocks that are overpriced. The big 10 tech stocks that led the market last year are starting to falter this week. If that happens to, if they're going to go down a lot, that could take the market with it. And what they'll do is they'll just correct to where they're fairly valued again. The one big thing that could cause problems is there's a Red Sea ship attack. And what's happening is there's companies that can't send oil through the Red Sea, and that could cause inflation to pick up again, and that's bad for stocks. Let's watch that to see if that goes away. Okay, so I think that's it for that. Okay, we're going to keep every week we're going to be keeping track of this first to worst. And right now, we do have information technology leading and consumer discretionary leading the worst sectors of this year. And that's opposite of last year. But that doesn't necessarily mean that you should sell all of your IT holdings. It's like I have most of my holdings are IT, and I'm holding them even though I know that there's going to be a rough patch here pretty soon because they're still growing. And right now, the ones that'll probably outperform are the ones that did bad last year. Okay, so let's look at, I looked at the market movers from this. Okay, so strong job market that came out today. That means the economy's doing good. Fed will raise rates or keep them higher. That's just every news story that comes out. You got to translate into, is it good or bad for the stocks that I'm following? And let's look at some charts that every once in a while I come up with some breakouts and some stocks that are at the bottom of their charts or whatever. Right now we have this healthcare. They're becoming a leader right now. A lot of the healthcare stocks that have been down 10, 20% last year are starting to outperform. And that's because we might be approaching a recession and people have a tendency to buy their medicine regardless if it's a recession or not. And they're safe, they're dividend, and they have low PE ratio. So we're going to watch this sector, see if it continues this breakout. And because it's been sideways for a super long time. Let's look at this one here. It's XLU. This is the utilities sector. It's up the most this year for all the sectors. And you can see it's right at the edge of a breakout. It didn't break out yet. It's been in this downward trend forever. Now, I'm thinking it's going to start breaking up to new highs here. And that's primarily because utilities need a lot of money to refinance their activities. So they need to buy new power plants and make new power plants, et cetera. But they take on a lot of debt. Whenever the interest rates go down, that helps them finance their activities. They make more money. And on top of that, if interest rates go down, people are going to be looking for yields. And this sector pays yields. That's why this is probably one of the better sectors this year. All right, so financials. As interest rates go down, they make more money whenever there's a net interest margin. Basically, banks they borrow short term and they lend long term. So if they can make more money in that spread, that's how they make their money. And it looks like they could be breaking out. I don't know. Right now they've been sideways here. Let's look at another one. Some of these drug stocks like AbbVie, they were in a sideways pattern forever, or downward pattern, and now they're starting to break out just a little bit. And AbbVie is a company that's paying a 4% dividend, and they're buying companies to replenish their drug pipeline because they have a couple drugs that are going off patent. Let's look at Apple. Apple has been sold off like 6% this week, and there was a news story that their iPhone shipments are going to be that great. So you can see they're still relatively in an uptrend, and they're super oversold right now. So this is a good time when they're almost at the bottom of the moving averages. You see these purple lines, these are moving averages. That's support whenever you have a big stock like Apple. This is a 100-day moving average. This is a 200-day moving average. And you can see that it's coming up to a lot of support for Apple. So it's sold off a lot, but there's a good chance that it could bounce when it gets to the bottom of this range and continue this upward. But we've been saying for a year now, it's super overvalued. It's not growing. People say that, it can manage a very high valuation because they have stable services income and stable amount they sell from the iPhones. But it's comparatively to other companies, it's super overvalued. So I'm not going to sell it, but I'm not going to buy any here because it's overvalued. This uranium. This is one of Dan Now's best pick from last year, and it continues to go up. This is basically uranium miner ETF. So we're going to continue to watch that, and they're oversold and at the bottom of this range, but it seems like there's still an uptrend. And I like to make a note whenever stocks or ETFs are at the bottom of the channel and the bottom of the stochastics. Okay, Verizon. this was one of the biggest losers last year. This is an example of a stock that pays a large dividend, like 7%, and they're becoming in demand now because interest rates are going down. It's going to be hard to get a large dividend. AT&T is very similar. It's going up because yields are going to be hard to find in the next year. All right, so AT&T, very similar chart. It was going in a downtrend forever, and now these high yield stocks are more in vogue, more in favor. Okay, so it's overbought right now, but T-Mobile is another one of the three biggest telecoms, and they're breaking out too. They were in a downtrend. So all the telecoms, which did very poorly last year, are starting to outperform, and they're one of the new leaders. Okay, and here's another little talk here from Dan Niles. Last year at this time, we were going over in this group his picks for this year. And at that time, he said he liked Meta because it had low valuation and growth. It was only trading at 15 PE last year, and no one wanted it. But what Facebook did last year was they actually cut costs. They stopped their spend on the metaverse, and they were profitable. And they were basically 289%, one of the top two performers in the S&P last year. So I'll follow up with each one of these two. MUFG, Japan, I don't know what the heck that is, but that's up 22%. It's and the URA is uranium, and that's up 34%. XLV, that didn't pan out at all. That was one of the sectors that didn't gain anything. And T-Wells, and that went up 5%. So it's great. He had some really good picks there, and he's really smart. So he chose his top 5 picks for next year, and I thought it'd be interesting to go over each of these and why. So for Amazon, he said they built up an infrastructure in the pandemic, and they have the ability to improve their margins because they have this infrastructure already set up in place. They raise the prices just a little bit, and they're able to make more money per transaction. So they're during recession, which we predicted, is going to happen like in the middle of this year. If that happens, they gain market share because people buy to save money, I guess, there. He still likes Meta because of reasonable valuation and growth. It's an AI beneficiary. So we'll go over each of these a little bit later. Texas Instruments, I don't like this as much, but he says it didn't go up as much as the other semiconductors last year. And he says that it should recover first because they went down first last year. And XBI, this is the biotech ETF. He says right now the valuation, there's a lot of drug companies that are going to be wanting to buy some of these, and the valuation will go up. And it's defensive kind of positioning in a recession. And the last thing, this is a very this is the one unknown for me. I'm not sure why he picked this, but it's a KWEB. This is the ETF for stocks from China. He says after 3 years of punishment, by China, the tide may be turning. So this is a contrary play. No one wants any of the China companies. But he says the top 3, Baidu, Alibaba, and Tencent, they're growing at like 30%, but they're only trading at 13 PE. So that's interesting. I'm going to go over some of the top holdings just to see if there's anything to what he's saying. So we're going to look at Meta. This is the earnings estimates for Meta. And you can see that they're very consistent, 15%, 19% for this last year to this year, 15%, 15%. So they're growing around 15 or 20%. The PEG ratio is about 1. So it's fairly valued, even though it was one of the top performers for this year. You can see Meta was up 167% this year. So that was like amazing, but that doesn't mean that it can't do good this year. So he said the theory is that they're using AI to help the effectiveness of ad delivery. And during the presidential ad spend cycle this year, there's an election next year. So they're going to spend a lot of money on ads. And you compare this stock to Apple. Apple has -1% growth in last year. And they have a 30 PE. And Meta has 15% growth with a 20 PE. So this is like, oh man. And how it's continuing to grow at like 15%. And the 4 PE is 20. So this is a very reasonable PEG ratio around 1 to 1.2. So their theme is, Meta's theme is they make most of their money on ads. They're making it more effective with AI. And they have an intangible device for their for like glasses. They have a Ray-Ban glasses that might be the next. Why is this saying that my battery's low? Oh man, I hope I can get this to work. Okay, so anyway, so he said that they have a good chance of outperforming the other big tech stocks this year. Okay, let's look at Meta statistics. The market cap's around 1 trillion. They have a PEG ratio, according to Google on Yahoo Finance, of 0.79. So Google thinks that they're growing around 25%, if that's true. Their profit margins are right around where we want them. We want them over 13. Return on equity is 22. That's better than the 10 we want. And they have a lot of cash. They have 30 billion in cash if you subtract the debt from the cash. So they're very financially stable company, and it's growing. So this is an example of a stock that you can buy and hold for a long time, and it'll grow around 15%. I'm not saying that this year it might not correct, but that's why he likes that one. Let's look at Amazon. Amazon is actually growing 25% if you take the earnings estimates going out next couple of years. Right now, the 4 PE is 37. So that means they're pretty reasonable, 1.48 PEG ratio. So their example of, they actually are also involved in AI. They have a growing ad business. They're going to benefit from presidential ad spending too. But like Dan now said, they gain share in a recessionary environment. So if this sells off as recession is shown, that means we have to keep in mind that they benefit from a recession. And they're offering AI with their cloud services, and as they have these efficiencies of scale. So they grew out their ability to their services centers and everything, so you can have overnight delivery and all that over the pandemic, but that's going to help them with their profit margins. So that's why Dan now likes this one. I think it's going to continue to grow at 25%. But you can see its PEG ratio of 1.48. If there was a big correction, it would have a PE of 25, which is like 30% less than where it's at now. So around 100, let's say around 100, that's when it would be fairly valued. It would have a PE of 25 and be growing at 25. So you're paying a premium for having this stable company that's a really large company that's still growing, projection at 25%. That's pretty darn good. Okay, so we look at Amazon statistics. Their market cap is 1.5 trillion. Their PE is 37, and their PEG ratio is 2.35. So Yahoo Finance thinks they're growing around 25% too. That makes sense, or maybe 20%. The profit margins are not that great. This is where the analyst thinks they can improve. So over the coming years, we're going to be looking at this profit margin and the return on equity, and according to the analyst, they should be going up because all they're going to be doing is increasing their price on their products just a little bit as they get more consistent sales there. So that's the total cash. They have 100 billion in debt out of 1.5 trillion. That's not a whole lot. Okay, let's look at Texas Instrument. This is the one that's iffy, if you ask me. From last year, they only grew at negative 1%. So I divided this year by this year. That's not so great. But they're supposed to grow 15% and 23% the next 2 years. And the PEG ratio is 2.5, so this is one of the worst ones, if you ask me, of his picks. Last year, they were only up 3%, and the summary index was up 65%. So Dan House thinks there should be a return to the mean, where this one goes up a lot because it didn't participate last year. You see. So let's look at the statistics for Texas Instruments. They have a 151 billion market cap, and total debt is 2 billion, 3 billion if you subtract out their cash. So that's nothing. And the return on equity is 45. That's excellent, more than 10 we want. And profit margin is 39. That's more than 10 we want. So the numbers look good. It's just a little bit it's pretty expensive though. It's a PEG ratio of 5. That's not that great. We want a PEG ratio around 1. So this is like the worst one on the specs that I don't like. But the last one he chose was XBI. It's a biotech ETF. This is an example of stocks that did bad in the last couple of years. It's going to outperform this year. So the first thing is, he knows that there's a recession that's going to happen. And this sector has been down the last 2 years. And he said it's basically due to outperform this year. And his themes are, for investing in this, the acquisition interest of the big pharmaceutical companies. There's a lot of pharmaceutical companies like AbbVie, Pfizer, and Bristol Myers. They're buying the biotechs for growth because they're losing their patents. So there's a theme there. And he says that these stocks will trade up because they see their peers being bought out, and the potential of the buyout makes the stock sell for a premium. That's one reason. Lack of profitability, need for capital, and rising rates. Okay. Okay. So the bad things were, there's like potential shift in demand for these biotech because of the weight loss drugs. These weight loss drugs that Eli Lilly and Novo Nordisk are making, they're kind of shifting the demand of other drugs. So that's like making the sector go down, because these are all reasons why the sectors are going to go down. But he thinks that big pharma companies are going to be buying them up. So it's just a return to the mean. It's about time for this one to go up. And the valuation for these companies are decent also. So, okay, this is the, let's go and look at our stochastics. We do this once every couple of weeks. It's always good to do that, but right now we have a little change. We already looked at the S&P, and a lot of the sectors are getting to a point where they're oversold. So we have about one more week before we're at a point where we're oversold, and that's approaching like that on a lot of these sectors. Let me see. Okay, so you can see this healthcare is the only one that's basically remained overbought. So as the I think the sectors and the worst to first are going to be the ones that are overbought right now, the worst from last year. Let's look at that, see if that's true. Consumer staples. This is the worst at first. They were worst last year, and they're in demand this month so far. Financials are the same thing. They were storing away last year with the problems with the banks going out of business, and now they're actually going to be doing better. So they're actually overbought right now and probably going up into this uptrend. Okay, so now we have utilities, same thing. They're in the process of going up into stochastics, and they're breaking out. And real estate, as the interest rates go down, real estate sectors outperform. So they're overbought right now. And energy. Energy is one of the worst performing stocks. Let's keep that open, that little window. Right here. Energy is another one that performed really bad last year that is outperforming right now. Okay, so now let's look at some of the uranium. Okay, we already said that. Okay, let's look at the stocks that we're following. You can see that AbbVie was in a 1-year downtrend. I mean, it didn't look really good. Now it's starting to break out into this uptrend. So I expect us to follow this uptrend pattern as interest rates go down. And let's look at Abbott. It's at a point where it could break out. It did not yet. Alibaba. This is an example. Everyone has lost faith in all the internet Chinese stocks. This is a contrarian play. It's I'm not buying it because I don't know what China's going to do to make their company disabled. But this is one of Dan Now's favorite sectors for next year. So we'll still follow this one just for kick. But it's overbought right now, but let's watch it, see if it goes up. Alphabet. You can see that it's still in its uptrend. It's one of the only of the big seven, magnificent sevens that are still outperforming, and it's overbought right now. Let's see. Altair Group. This is an example of a stock I expect to break out because it's going to be real hard to get a 10% yield after interest rates go down in the coming year. So let's look at Amazon. This is an example. It's grown at 25%. It'll probably correct down to here. It's a little bit oversold right now. It's actually almost all oversold. So it's almost a good time to buy Amazon. But you can see it's like Google. It's still in an uptrend, and it's still very powerful, and it'll do good in a recession. So it's an example of a stock that'll do good in good times and bad times. So get this one, Apple. You can see it's been in an uptrend for over a year, but you can see it's starting to correct. It's hitting its moving averages, and there's a lot of support there, right at these moving averages, and it's oversold. So there's a good chance it'll trade down to the bottom part of this channel, and we'll see if it goes down to here, out of this channel, then watch out, it'll go the whole way down to 130. Right now it's like at 180, 80 or something like that. But if it was down to 130, that's its fair value. So I'm ready for that. I'm holding it for a long term. It's still within this trading range. That's decent. So the AT&T example, a high yielding stock, it yields like 7 or 8%, and it's going to be in high demand as interest rates go down. So this one is starting its uptrend, and it's overbought right now. So it can wait like another week or two before it goes down to here. Okay, Bristol Myers. This is one that people are basically throwing out right now because the earnings estimates aren't that great, but they're actually buying some of those biotech companies this week, and so they might return to growth, but it's like a crapshoot. I'm not willing to take that risk, but we're going to follow it anyways. I expect this to like break out like the other biotechs, but it's not something that has fundamentals behind it just because it's in a sector. Okay, let's look at Colgate-Palmolive. It's still stuck in this trading range right here. I don't know if it's going to get out of that. We'll see. CSX. Okay, you can see that it's still in this small little uptrend. It pays dividend, and it's overbought, so it's not a good time to buy that one. Yeah, better time to buy would be right here. The Meta is actually just like Google and Amazon and Microsoft, it's still in an uptrend, and it's still growing at 15%. It's overbought. It's going down a little bit this week. There's people selling it because they made a lot last year, and they want to take some profits in the first week this year. But if this stock, corrects down to here or something like that, then it will be fairly valued. But right now it's still in an uptrend, and it's probably still going to be growing 15% a year for the next couple of years. JP Morgan, they're still in an uptrend here. They haven't broken out of this channel, so it looks like, and they're overbought. I think the biggest news for them is their interest rates are coming down. They're going to make more money when they lend out money because of that. And on top of all that, they bought a company almost for nothing last year, First Republic, when they went out of business. So they're the biggest bank in America. So that there's economies of scale whenever you have a big bank like that, and you can make more money because you have a lot of business. All right, so Microsoft, it's still like the other tech stocks in an uptrend. I expect it to go back down here. It's almost the point where it's oversold. So this week, all the big tech stocks, most of them, sold off a little bit here. And it'll probably go back down to here. Then after that, we have earnings at the end of this month. So that'll be what kicks it up into this range next. If that happens. If it goes down out of this channel, then watch out. It'll go down to here or here. We don't know. But so far, it's contained in that little channel. That's good. Okay, Pepsi. This is an example of a stock that was in a downtrend all last year because people were afraid people wouldn't drink Pepsi or eat Fritos because of the weight loss drugs. But people are going to be wanting a steady company that pays a dividend while the interest rates are going down. So I'm thinking this is going to break out to here and go to here and go to here next. So we'll see what happens. But they're overbought right now. So we'll see. Procter & Gamble, this is an example of it's overbought right now, basically in a sideways channel. This is an example this is a consumer staples. It was down 3% last year. So I'm expecting that sector to outperform this year. So I'm guessing this is going to break out with all the other related stocks this year. Starbucks, it's still in the downtrend. There's a lot of doubt for China expansion. That's why I think they're down a lot. Verizon, you can see that it broke out of this long-term downtrend. I think the telecoms are going to be the best performing sector this year. Let's look at that telecom. I guess that could be considered a utility, but it's turning out that they're all breaking out right now. And with the lower interest rates going down, they're going to be in higher demand. That's kind of what I was saying like two months ago. I said this is the time to start buying the higher yielding stocks and indexes because that as interest rates go down, they're going to be in higher demand. Let's look at the Visa. So the theme for Visa is that most transactions in the world are cash, and they're moving toward a digital wallet or digital credit cards. So and they make money in a recession or in bad times or in good times because they basically take a toll for every transaction, and they don't take any. They don't assume any risk for the transaction. So if there was a fraud, or the bank usually covers something like that. So that's why this stock continues to do good. And with the job reports today, that shows the economy is doing good and jobs are doing good. People are going to still buy things, and it just so as the economy grows, the more people spend, and that's why this continues to go up. So let's see, Waste Management. They're actually were in a sideways for a long time, and they're starting to break out. They pay a dividend, and that's an example of a reliable dividend payer. Whenever interest rates are going down, this will be in higher demand. And Amgen is an example of a stock that was, it's breaking out now. It's one of the drug stocks. So drugs are one of the best sectors that are, see, they were down 1% last year, and this year they're becoming the outperformers. So we're going to keep our eyes on all the drug stocks. CVS is an example of another drug stock. It's a healthcare stock. So if you look at their healthcare down 1% last year, and it's starting to go back up. But I still don't think this is a good stock to buy. It's not growing a whole lot. Johnson & Johnson isn't breaking out like the other ones. They have too many problems with talcum powder lawsuits and stuff. I don't know. I wouldn't want to mess with that. Walmart, they're continuing an uptrend. You can see that they're overbought right now. Not a good time to buy that. And you see they pay a dividend too, so maybe that could help the stock this year. Tractor Supply is still in a downtrend. They're oversold, and Berkshire Hathaway is kind of going up with the financials. And so they grow around 20% a year if you go back to 1965. So next time the stock market corrects a lot, I'm going to start looking at this because it's one of the safest, most diversified companies in the stock market right now, and it's pretty big too. And MasterCard follows Visa theme, and they take money for every transaction. That they're a toll collector, and they're growing around 20% a year. Believe it or not, their earnings estimate. So this is one of my Visa and MasterCard, two of my favorite stocks because I know that they'll do good in good times and bad, and there's no regulation right now stopping them duopoly. So let's look at eBay. Their earnings estimates aren't that great. I think they're going to continue this downtrend because right now there's no catalyst for the company to go up. I think they're losing a little bit of market share to Amazon. So that's not that great. Let's look at Boeing. So Boeing is in an uptrend here. They have a hard time with their quality control. They're just about oversold. So that's probably a good time to start looking to buy them if you're interested. That'll be the perfect time right there. Tesla it was in an uptrend for a long time, but you can see it's starting to go sideways. And I'm not sure why that's happening, but I think it's starting this new pattern where it's going to go, here and here next. So it's oversold. And I'm thinking, if we look at our calendar, a lot of these stocks that are oversold might be oversold for another week or something. And then you have earnings reports starting to come out this week and this week. And a lot of times that's a catalyst for them to go from oversold to overbought. So let's see. NVIDIA, it's less expensive now than it was 1 year ago, even though it ran up, 200% because of their earnings. They're so great. So I'm still holding this stock, and looks like it's, we don't actually know what the earnings are going to be because they're growing, and they're growing so much, and there are companies that pre-order their chips. So if you order 3 times the amount that you need in a year, and next year you won't order anything. So that's the way it is with chip businesses, and we don't know what's going to happen in their next earnings report. It's kind of unknown. Right, so the other one is Nike. It's kind of in a sideways pattern, and it's oversold. So it's at the bottom of this range here, and it's oversold. The only problem with Nike is it's super overvalued. It's like 2 or 3 times, trading at 2 or 3 times their growth rate. So the PEG ratio is 2 or 3. So it's getting pretty expensive. And Ford Motor Company, they're not growing at all. And looks like it's stuck in a sideways pattern basically forever, and they pay a 4% dividend. That's not something I would buy for a growth stock. And Costco, this is basically hitting all-time highs because their subscriber growth is around 8% a year. And they have a renewal of like 98% satisfaction for their members. So that's why it's continuing. They're growing overseas. So that's why they continue to go up. And I'm waiting for it to go down a lot someday, and then I'll buy it. But right now it's super overpriced. T-Mobile was the other telecom that's continuing this uptrend. And I think it doesn't pay a dividend, but it's going up with the other telecoms. So that sector is doing really good. It's an all-time. It's a overbought right now. So there you have it. That's a good run of the Stochastics. Does anyone have any questions or stocks you want to go over? Can you hear me okay?
Yeah.
Okay. You never know until yeah. All right, that sounds great. Well, thank you very much for attending, everybody. If you have any questions during the week, let me know, and I can try to help out. And hope you have a good weekend.
Thank you.
Thank you, Greg.
Bye.
Thank you, Greg.
Thanks, Greg.
Thanks.